originating loans. All right, so hi everybody, and I'll hand it to you, Eli.
All right, thank you, Alek. Hi, everybody. My name is Eli. I am originally from Haiti. I came here pretty young. I'm actually a survivor of the 2010 earthquake, which is the reason I came here. Now I find myself in real estate. I'm a realtor with Keller Williams. It is truly my passion. I have a background in accounting, but I chose real estate because it's what I love to do. And yeah, I hope you guys are ready for this presentation.
All right.
Alec,
My name
I
is.
started the recording process.
All right, perfect. Let's do it.
Let me just make sure I mute everyone.
And guys, if you have any questions.
Oh, sorry. Sorry. All right, can you unmute?
I did. Okay.
All right, sorry about that. All right.
All right, so if ever anyone has any question during the presentation, please raise your hand. We will have a Q&A session at the end. So let's dive in.
All right. All right, so the agenda for today is that we will be going over the home buying process. So we will be helping you guys determine your budget, getting approved for a mortgage, how is it like working with an agent, looking for a house, making an offer, the home inspection, securing your finance, and then home sweet home. All right, so you're deciding to buy. Well, before deciding, yourself why? Are you renting right now and you're tired of renting? You want to start building wealth, build equity through owning a house, or are you looking to invest in real estate? All right, so some things to think about. So when deciding to buy, these are some things to think about. Location, where do you want to live? Your timeline. When do you want to live there and how long do you want to live there? And then primary or investment property. Do you plan on living in that property yourself? Or do you plan on using it as an investment property, like renting it out for passive income? All right, some more things to think about. Your income versus your debt, your credit score. I say this is pretty, very important, your credit score. Employment history. How long have you been at your job or your employment? Upfront costs associated with buying a house. All right, so let's dive into it. Let me know if the slides or on time if they're moving.
They are. I see them moving. We're at determining your budget slide right now.
Okay, cool. All right, so first step when deciding to buy is to evaluate if you're financially able to buy a home. You might be willing to, you might be ready to buy, but are you financially capable of buying right now? And that's why we determine your budget. All right, let me know when okay, I
Yep.
see. So there are three things when it comes to there are three things to calculate when it comes to determining your budget. Number one, your income. Number two, your expenses. And number three, your savings. All right, so your income. So this is pretty simple. This is money coming in. It could be from your job as a form of salary, bonuses. It could be an investment. Maybe you already have a property that you're renting out, an investment property, etc. So any type of money that's coming in, that is income. And for instance, if it's salary, that's usually an annual amount. You'll just have to divide it by 12 to get the monthly amount. All right. Sorry, let me go back. Okay. Let's look at an example. So in this example, your income source is a job, right? That's source one. And your salary is 70K a year. and that comes about to $5,800 a month if you divide it by 12. And yeah, so the goal here is to get the monthly amount, so the monthly income. But this 5,800 is before taxes. So let's look at your take-home pay, which is after taxes. All right, can you see the slide?
The slide hasn't moved yet on my end here. I don't know if anyone else can see it.
Has it moved?
Now it says take home pay is 4,800.
Okay, yeah, that's right. Okay.
Okay.
All right, so after taxes, your take-home pay would be about 4,700 to 4,800 a month. Here we say 4,800 a month. So, this is how much you're taking home with you after paying taxes, right? This is actually the amount that you have available to spend. All right, so now we are done calculating your income. Let's move on to your debt. Just give it a second for the slides to update. All right, so after calculating your monthly income, you now calculate your monthly expenses. So this is money going out. Pretty simple, like income. So if it's annual, you simply divide it by 12 to get the monthly amount. If it's weekly, you multiply by 4 to get the monthly amount, right? So money going out, that could be subscriptions. Like for myself, I know I have Netflix, Hulu, Prime Video. I wish there was like one tool that had everything, but unfortunately not. But I have subscriptions, car insurance, gas, groceries, and eating out. So these are examples of expenses. All right, so now let's look at an example of calculating the expenses. All right, so in this example, we have a list of expenses. We have housing, which includes rent and utilities, right? So pay close attention to the 1,500 because this will come up later. So we have auto transportation, $500, food and groceries, $400, loans, $200, and etc. That could be like miscellaneous expenses, $100. So if you add all that up, it comes about to $2,700 a month. So your total monthly expense is $2,700. All right. So after calculating your monthly income and your monthly expenses, you then compare the two. So this will show you how much money you have left over after covering all your expenses. So from the example before, your income was 4,800 and your monthly expenses came out to 2,700. So when you do the math, you're left with $2,100 a month for free spending. So that's money you have left over after paying all your expenses. But now let's look at what amount you have available to cover a house payment. So before we saw how much you have available after paying all your expenses, including your house, maybe you're renting. But now let's look at the total amount you have left if you wanted to cover a house, right? So you would simply calculate your monthly expenses, but you would now exclude how much you're paying and for housing. That could be renting, or if you already own a house, that's how much you're paying in mortgage, right? So in this example, we have 4,800, but now your total expenses is 1,200 because it's excluding the housing payment. All right. So when we do the math, we have $3,600 left remaining for a house payment. So this tells you how much money you have left if you were to buy a house. If you were to buy a house, how much money you have left to cover that house. And the reason we do this calculation is so you're not what is called house poor. So what that essentially means is that let's say you have a mortgage, you have a house after paying the mortgage and covering all your expenses, groceries, car insurance, and everything. You will have no money left over whatsoever for anything else because all your money is tied up on expenses. So this is why it's so important to do this calculation. All right, but let's say your budget is lower, right? Let's say your income is lower. That just means you have less buying power. And that's where a real estate agent comes in, right? To talk about different strategies that can help you get into the market. You can't just say, oh, my income is too low. There's no way for me to get into the market. So that's why it's so important to speak to a realtor so you can find out, okay, what can I do to get into market? So maybe in order for you to get into the market, you'll need to house hack. I'm not going to go into that too much, but that is a strategy that you can utilize. Maybe get into a starter home and then move out and then get another home and use that starter home to pay um, for that other home, the next home that you're getting. All right. Just give it a second for the slides to update. Okay. So we've determined our budget, and it tells us how much we have available to spend every month on a house. But what about the upfront costs associated with purchasing a home? And what those are down payment, the down payment, closing costs, upfront repairs, if necessary. All right, so let's talk about the down payment. All right, so when buying a house, your lender is going to ask you to put some of your own money down, and this is called the down payment. And this is a percentage of the purchase price. And it is kind of it's based on the type of mortgage that you get too. And it all depends whether you're living in it or you're renting it out as an investment property. And it usually comes out to 3% to 20%. But you can always put more than the minimum down payment. Based on the mortgage, there's different minimum down payment requirements, but you can always put more than the minimum requirement. All right, so let's take a look at the minimum down payment requirements for each mortgage type. So this is based on if you're living in the property. So this is for primary residences. So feel free to actually take a screenshot of this. You can save it for future references. So FHA, we have 3.5% down, conventional 5% down, and then you got the VA and the USDA, which are 0% down. And Alek, I don't know if you want to step in and talk a little bit about this right here, like the different minimum down payment requirements.
Absolutely. So first, I want to give a quick explanation of the types of loans. Like you mentioned, these loans are primarily focused on the on your prime residence. So basically, unless it's a conventional, you cannot use these loans to purchase an investment property. The FHA requires a 3.5% down payment. This is the Federal Housing Administration. They do guarantee and back up these loans. The difference that these loans have with the others is that the house needs to be in a move-in ready condition. So a positive on a buyer's side is when we're using this type of loans is the lender will not approve the loan unless the house is move-in ready. So if there's a broken window, if the toilet is not working, if the roof is leaking, you can go with peace of mind knowing that the lender will not even finance this house unless all that is repaired. Conventional is the most typical type of a loan. It's usually 5%. There's options where you can go down to 3%. And then VA is for veterans, people that have served in the military. They do get a 0% down payment type of a loan. And USDA is a loan that's specifically meant for rural areas. And they have their own website. So if you want to see if a property qualifies or not, you just go to this website, you type in the address, and it will let you know if the property qualifies for USDA loan. You can purchase it with 0 down payment.
Nice.
Yeah.
All right. Just let the slide update real quick. Okay, yeah. So don't forget about closing costs, right? So we usually hear about the down payment, but there's also what's called closing costs. And these are variable. So they usually are estimated to be about 2.5% of the 2.5% to 5% of the loan amount, not the purchase price. The down payment is based off the purchase price. The closing cost is based off the loan amount, right? And these costs come about through the process of creating your loan. So this is loan origination fee, application fee, appraisal, attorney fees, title insurance, etc. All right, let's go to the next slide. All right, so let's have a quick review. So we talked about the down payment, which is the percentage, which is based off the purchase price. We have the closing cost, which is based off the loan amount, and then we have the minimum down payments, which is for primary residence. Those are for primary residence. All right, now Alek will be dropping some knowledge about the financing aspect of this process. But here's a quick overview of like the documents that's required when you are starting the pre-approval process of getting a loan.
Right. So basically what the mortgage lender is looking for when somebody comes in and asks for a mortgage is they want to see some financial stability. When it comes to employment, we're always looking for at least 2 years history being in the same job or at least in the same type of business. So if you, even if you switched jobs, as long as you stayed in the same type of line of work, it's fine, but we do need a 2-year history. Now, this is a guideline. It doesn't mean that if you have like 1 year and 8 months, you're not going to get a mortgage, but it's just for guideline purposes. So when someone comes in and asks for a mortgage, these are the typical documents that we ask. We would ask for the last 30 days of pay stubs. We would ask for last 2 years of tax returns, the past 2 months of bank statements, and then employment history. Like I said, we need the last 2 years, and we can verify those. I believe it's going to be the next slide we can switch on by either asking you for your W-2s. That's if you're employee making salary or making per hour payment. Or if you're self-employed or a contractor, you're going to be a 1099 independent contractor. Same thing, we're just going to need the last 2 years of your 1099s. Additional items will include your credit report, gift letter. That is, for example, if you don't have the money to come up with for a down payment, you can ask a relative or somebody to borrow this money to you. However, the lender needs to know where did this money come from to prevent any money laundering. So that gift letter is going to state who is the person that gifted you the money. If you have student loans, we will need to see those. And then we also need to see any investment accounts, any reserves that you may have sitting, just to get a good financial picture of how is your finances. These all factors play into the approval of the mortgage. After we collect these documents, give us about 24 hours and we'll come back to you, let you know whether you're eligible for a mortgage or not. This is the initial start of the mortgage application. We send these documents then to an underwriter, which is a person that evaluates all the documents and comes up. If everything is absolutely clear, they will simply approve the loan. If they have anything that they're not sure about, it's not clear, they come back with what's called conditions. These conditions, a lot of the times, for example, they will say, okay, explain to me your credit report. Why does it say this? Why do you have so many cards? Or why do you only have one card? There's always just, there's some questions that the underwriter may need to ask to get that perfectly clear picture of your financial of your finances. Once we clear up those conditions, we are now ready to fund the house and to get it closed.
And
Yeah.
quick tip, right? You guys can start saving these documents right now.
Yeah.
You don't have to wait until the last minute when you start the application to start looking for your W-2s, your tax returns, and whatnot. If you know you're going to be purchasing a home the next few months, why not start the process of like maybe your phone, your computer, create a folder on there and name it home buying documents and start compiling these documents right now.
Exactly. Know where they are so that when we need them, they're going to be easy to be accessed. So on credit score, let's talk about the credit score. It's one of the biggest factors that determines your home loan interest rate and other terms. They're basically, we know that everything we do financially, it's being scored. Every time we make a payment, it's being reported as an on-time payment. Every time we miss a payment, it's also reported on these 3 credit bureaus as a missed payment. Those credit bureaus are Experian, TransUnion, and Equifax. And it's always a good idea to keep a pulse on your credit, know where you stand, know who is reporting what on your credit score. And as it says in the slide, once a year, you're entitled to getting a free credit report. Simply go to annualcreditreport.com. There's so many sites advertising free credit reports just to get your information. This is the only one that it's approved by the government that actually does give you a free credit report. And with that credit report, you can absolutely know where you stand. There's also this Credit Karma, I believe. You can check, and nowadays your credit cards can also alert you every time somebody's posting something on your credit. You get an alert, and that way you keep, like I said, a pulse on your credit. If you ever see anything that's that shouldn't be there, immediately dispute it. Make sure it's cleared from your credit report. So one of the most important things when it comes to credit is never ever miss a payment, because it not only that it negatively affects your credit report, but the lender is going to be able to see that you have a missed payment and immediately start worrying, well, what if they miss their mortgage payment? These are the banks that also will follow and track your credit report. So if you're banking in any one of this, Wells Fargo, Capital One, Bank of America, they'll keep you updated at all times. Minimal credit score to get a mortgage and to purchase a house. FHA loan would be 580. Conventional is 620, VA 620, and USDA 620. Now, this is just for a guideline purpose. We've seen FHA loans getting approved with down to 500 FICO score. However, the less your credit is, the higher of a risk you are to the lender. So they're going to ask for more skin in the game for you. So if your credit is less than 580 on an FHA loan, you're going to need to come up with 10% of a down payment in order to qualify for a mortgage. On VA, there is actually no requirement. There's no official guideline. You can basically not even have a credit. However, the 620 number is for you to get the best possible terms. If you're under 620, your interest rate on your loan is going to be a lot higher than if it's above 620. And then for US DEAs, the 620 is also the magic number where you get the better scores, the better interest rate. So yeah.
Yeah, and I actually use Wells Fargo and Capital One, and they tell me Wells Fargo tells me my FICO score.
Perfect.
Yeah,
Perfect.
and Capital One I think shows me because they have different models. But yeah, Capital One shows me something else. I can't remember the name. I think like Vintage or something like that. But yeah, Wells Fargo does a pretty good job at telling you your credit score.
Right. So debt to income ratio. So at the beginning, Eli talked to you about budgeting, having this the accounting background. He's telling you the smart way to keep track of your finances. The way we calculate your income for mortgage purposes is basically we do take the gross amount of your earnings. We don't take out the taxes. So we calculate if you're in the beginning, he gave an example. If you're making 5,800, right? That's the number we actually take into consideration as your income. As far as debt, when we calculate debt, we calculate credit cards, car payments, student loans, child support, as well as anything that you have revolving that's coming out, any leases and any things of this kind. Your utilities, your subscriptions, your monthly subscription, your food grocery payments, those are not calculated because we don't know, we cannot predict what are you going to spend, what you spent last month, if you're going to keep spending like that or you're going to change your spending habits. But we can see exactly how many months you have left to pay off your car, or how many months you have left to pay your student loan. And this is why we take this only this things into consideration. And again, one more very important thing, don't ever allow yourself to go in and have late payments. So DTI is debt to income ratio. Usually we need to be around 45%. Meaning when we take when we use the formula that's on the screen, we divide the monthly debt by monthly income. We need to come up with a percentage of 45. I've seen loans getting approved with as high as 53. Those would be the FHA type of loans. And if you have good financial picture everywhere else, you're making good money, you're saving. However, let's say you have high student loans, right? You had to go to school and pay a lot of loans to get to a point where you're making a lot of money and you're now saving. So your debt to income is not all the way there. We do take into consideration the rest of your credit is good, your payments are on time, so we can allow the debt to income to go higher. These are called compensating factors. So even if you have late payments or you have somewhere you messed up something, nobody's perfect. Everybody has something in their credit history or in their debt to income. So that's why we want to take the whole picture, make sure that you have a healthy finances. And if you're lacking somewhere, we compensate them by other factors.
All right. So now we are going to talk about working with an agent. So real estate agents assist buyers and sellers with transactions by providing market expertise, negotiation skills, and personalized support to simplify the real estate process. All right, so responsibilities. So what are the responsibilities of a real estate agent? So as your real estate agent, I have a legal and ethical duty to act in the best interest of you as my client. And this is known as fiduciary duty. And depend on what type of relationship we establish. Let's say it's a exclusive relationship, the level of fiduciary duty will be different, right? That means you're working with me exclusively only, right? I'm the only agent that you're working with. That means I'll have a higher level of fiduciary duty towards you. But let's say you're working with multiple other agents. That's when we kind of get into that gray area where my level of fiduciary duty might be less because I know that you're working with multiple other agents and you have more help than you actually need. You have a lot of help. So yeah. All right. So how does it work, right? How does working with a real estate agent work? So there's about 7 steps to working with an agent to purchase a home. You have the consultation, the home search, making an offer, negotiate on the purchase price, help with inspections and due diligence, closing and post-closing. All right, let's go to the next page. All right, so the consultation, right? So this is the first step. During the consultation, as your agent, I will sit down with you and I'll discuss your needs, your preferences, your budget. Basically, I will see what are your goals, what are you trying to achieve, and what can I do to serve those needs. All right, so during my consultation with you, even if you don't have these questions in mind, don't worry, I'll direct you. I'll come up with some questions to feed you and to have you think about. But some questions you should be asking yourself may include location. This came up in the beginning, right? So where do you want to live? Timeline, when do you want to be there? How long do you want to be there? Is this your forever home or is it a starter home and you plan on moving out in a few years, short few years? How many beds and bathrooms do you want? How much space do you need? Are you going to be living by yourself, or do you have kids, or do you have roommates, or whatever it is, right? How much space do you need? What amenities do you want? Do you want a pool? Do you want a big backyard and stuff like that? And what are your must-haves? Your must-haves are, it's like, I have to have this or I'm not buying this house at all. That's like you can't live without. And then nice to haves are things it's nice to have, but you can live without it. It's not going to kill you. All right, let's go to the next. So now during the consultation, I don't know if all agents do this, but I do. I want to ensure that you, as my client, understand how I am compensated and who is responsible. Are you responsible to pay me anything? So let's talk about it. So first, we need to understand what is a buyer agent and what is a listing agent. So a buyer agent, it's pretty much in the name. They represent buyers. And listing agents, they represent sellers. So buyer agents help buyers find suitable properties or homes. Listing agents, they help market and advertise properties for the sellers to get it sold. All right, so now who pays the agent, right? How are listing agents paid? So listing agents are paid a commission, which is a percentage of the property purchase price. Excuse me. Listing agent's commission comes from the seller. The seller and the listing agent get together and they negotiate the commission before listing the property. All right, just make sure it's updated. All right, now who pays the buyer agent, right? So as a buyer, you can usually work with the real estate agent for free. So let me explain. So buyer agents are paid a commission, which is a percentage of the property purchase price, the same as listing agents. Most of the time, the buyer's agent's commission comes from the seller, and that's how buyers usually can work with a real estate agent for free because the seller, most of the time, not always, but most of the time, they offer commission for buyer agents. The commission for buyer agents can be negotiated between the seller and the listing agent before listing the property. So what this means is that the seller and the listing agent, they get together. The listing agent say, okay, I negotiate with you this amount of commission for me, and then this is the amount that we're offering for buyer agents, so it brings in traffic, so the buyer agents can bring their buyers to the property. But let's say if the seller doesn't offer commission, they say no. Oh, sorry, hold on. But yeah, if the seller doesn't offer commission, the buyer may need to compensate their agent directly. All right, let's look at an example for that. Just give it a second. All right, so in this example, the listing agent and the seller come together and say, we negotiate 6% commission, right? The listing agent negotiate 3% for themselves, and then they are offering 3% for buyer agents to bring in traffic. So right here we have 6% split down, 3% for the listing agent, 3% for the buyer agent. And then the buyer agent and their buyer come together and say, the buyer agent asks for 3% commission to be paid by the seller. Since 3% is being offered to buyer agents, everything is cool here. There's no issue over here. So we're all good. But let's look at a different scenario. So let's say in this scenario, the listing agent and the seller come together and negotiate for 5% commission in total. 3% goes to the listing agent right here, and then they're offering 2% for buyer agents. But the buyer agent and their buyer negotiate for 3% commission. So you can already see there's a problem here, right? There's a 1% difference because the listing agent and the seller is only offering 2%, but the buyer negotiated with the buyer agent for 3% commission. So who's going to be responsible for that 1% difference? Is the buyer going to be responsible, or is it the listing agent or in the seller going to be responsible? And that's where you have to get everything in writing and get it on the contract. But in this scenario, the buyer may actually be responsible for that 1%. That's why I said most of the time, not always, buyers can work with the real estate agent for free. All right, just give it a second to update. So yeah, this is the contract right here. That's why it's so important to as a buyer, when you're working with an agent, that agent should explain to you how the process works for commission and how they're being paid. What are you responsible for? If the seller doesn't offer this much, who's responsible to pay that? You, or are they responsible to reach out to the seller and listing agent themselves and negotiate for their the difference between commission? All right. So after the consultation, we both have a part to play. And that's if we connect with each other, if we like each other, we vibe or whatnot. We have to decide if we want to work together. So that's when we establish a relationship. And I'm going to sound like a broken record here, but always get everything in writing. It's best to get pretty much in real estate, get things in writing. All right, so after the consultation and establishing a relationship with your agent, that's when we start looking for homes. As your agent, I'll narrow your search. The more narrow it is, the faster it is, because we don't want to look at 100 different properties. So we want to narrow down your search criteria to see exactly what you're looking for. So I can send you a few listings that meet your criteria, and you can just look through them and say, okay, I like this one. Let's go after it. All right, so as your agent, I will add you to a MLS subscription. The MLS stands for multiple listing system. So this is what I have access to as a realtor, and it shows me all the available listings, pretty much in Florida or within my the board, because I'm a realtor and I have access to the MLS, and it's part of like my membership for being a realtor. So I'll have access to see all the listings available. And when you are subscribed to this subscription, the MLS subscription, you will get automatic alerts for any new listings that meet your search criteria. And let's say you're looking at a property, but it was priced too high, right? If there's a price reduction, you will get an instant notification of that price reduction. Maybe that property was the one that you really wanted, but it was just priced too high. But once the price change, if there is a price change, you'll get an automatic instant notification of that listing. All right, so let's actually look. This is an actual picture of the MLS. You can see here all the different criterias. I can filter through area, where do you want to live, right? Status, active, expired, expired. So for instance, let's say you're not finding anything that meets your criteria that is active. Maybe we need to look at expired listings and and as your agent, I'll reach out to the listing agent and say, okay, I have a buyer that's really interested. Would you be open-minded to putting this property back on the market? Because sometimes that's what we might have to do. And then of course, city and list price, county, state, which is Florida, zip code, type, bedrooms, bath. So there's like, you can see here, this is not even the full list. We can really like zone, narrow down, and really like get exactly what you're looking for. All right, so let's say you find something you like. This is when, as your agent, I will schedule a showing time for both of us to go see the property. But let's say something comes up, maybe you're just too lazy to go or something like that. Well, thank God to technology, because nowadays we have FaceTime, we have the VR set even, maybe I can use that. But yeah, as your agent, if you can't attend the showing, I can go there for you. I can go there, take some pictures, take some videos, FaceTime you, and show you the property virtually if needed, if needed. All right. So now let's say you're not seeing anything that you like, right? And that's where communication comes in. Maybe all the listings that's coming at you, it's just not meeting your criteria. Maybe we need to go back to the drawing board and see, okay, what did we do wrong? Maybe we need to refine your criteria. And I know sometimes like we might be shy, or we don't want to say how we really feel about something. We want to, maybe you don't want to bother your agent and say, "Oh, I don't, I'm getting all these properties, but you're working so hard, but I just don't want to say anything." So, as your agent, I'll save you the time, I'll save you the trouble, and check in with you, because it's like a real relationship, right? You don't want your partner to just, you don't want to assume your partner is 100% happy all the time. That's why you have to check in with them and maybe say, "Hey, babe, how's the relationship going? Maybe there's something that I could do that could better their relationship," right? So the same way, working with an agent, they should be checking in with you to see, okay, how's the process? Do you like working with me? Do you like the properties that you're seeing? Does any of those pique your interest and whatnot? So that's communication right there. All right, just give it a second for the, okay. So let's say you see something that you really like, but you don't just like it, you want that property, you want to buy it, right? So this is when I come in as your agent and help you make a smart offer. All right, so making the offer with your agent. So when making an offer, you do not just want to offer what the sellers is asking. As your agent, I will perform what's called a CMA, a comparative market analysis, to help see, okay, is the price that the listing is at, does it make sense for you to offer that amount, right? We don't want to give an amount that's like overpriced, where we could have gotten a better deal by seeing if the price actually makes sense. And then, of course, I'll help you draft the offer. Include I'll include terms, conditions when we want to when we want to close on that property, and then of course submit the offer. I'll help with that as well.
Right here, I just want to add, Eli, if you don't mind, that in this process, we work closely with Eli. He always lets me know. For example, for you guys to go shopping, we need to get you pre-approved, right? But then he comes back and tells me, "All right, Alek, we're looking into this house. What do you think?" So on our end as lenders, we also run comps, make sure we know that this house is something within the value proposal. we do get a call from the listing agents. Once you submit an offer, the listing agent calls and says, hey, how is this borrower? We just received an offer. Are they good? Did you check credit? So we work very close between the buyer agent, the listing agent, myself. We consult, and the listing agent looks into the whole picture before accepting the offer. They are serving their own clients. They want to make sure that they get the best possible offer. So once again, working with good agent, good loan officer comes into play if you want your offer accepted, especially in hotter markets when people are competing, they're having multiple offers. So when it's going to come down to between two similar offers, we may be able to win it for you based on the arrangements that we made, based on how comfortable we make that listing agent feel about your offer.
Yeah, well said. And when making an offer, like two things can happen. Number one, the offer can be rejected, and the listing agent and the seller send a counter offer, right? Which is like a whole new contract. Number two, the offer can be accepted, which means all the proposed terms and conditions that we wrote in the offer is accepted. And once the offer is accepted, we have, it's on the next page. We have the due diligence period. So this period is usually 15 days in Florida, and it gives us time to carry out inspections, appraisal. Based on the inspections, maybe we need to renegotiate title insurance, homeowners insurance, title search, review disclosures, documents, secure your financing with the lender, with Alek. And then, of course, most importantly, the final walkthrough. We're actually going to go into that. Okay, so during the 15 days due diligence period, you have time to carry out the inspection. So what we'll do is we'll schedule the inspection to identify any potential issues that the property may have, right? So if we find any major items, we can actually use those items to maybe get a better price, renegotiate with the seller and the listing agent. And then the appraisal. So Alek, this is often required, right?
Yes, appraisals are required most of the time. The only instances when we would probably not need an appraisal is if you're coming up with, if your financial picture is really strong. We can see on our end that the house is valued approximately where it should be, and you're coming up with a substantial chunk of down payment, usually over the 20% down payment. We may not need an appraisal. Now, what is an appraisal? An appraisal is an inspection ordered by the lender. So what we do as lenders, we send an appraiser to go look at the property. They physically walk inside the property. They walk around, make sure the house is there, make sure and they also they measure the square footage. They will check what has been sold in the area, and they come back with a value of opinion of a value. So that usually should match the contract that you have between the buyer and the seller. If it doesn't, if the lender feels that the house is worth more, than great. That means you have instant equity into the house. You're purchasing a great deal. But if the lender thinks it's lower, then there's few options right there. You can have your agent, Eli, go back to the seller and try to renegotiate the price, or find meet in between. Either way, it's gonna the lender is only gonna lend on the lower of the contract or the appraisal. So in the first instance, if the appraisal comes in higher, we're going to be lending on the contract amount. If it comes in lower, we're going to lend on the appraisal amount. So that's a way the lender can keep themselves safe. So yeah, appraisal is definitely needed most of the time, unless you're putting, again, a big chunk as a down payment, or of course, if you're paying cash, then you're not going to need an appraisal. Although I've seen it a lot of times, people actually still end up getting an appraisal just to make sure if they're getting into a good deal or not, for their own peace of mind.
It's really good.
Yeah.
And then so the title search and title insurance. Title search, basically a company or attorney will look into the seller's legal ownership of the property, make sure they actually own the property. And then title insurance protects you from any future claims. Maybe somebody comes out of nowhere and say, hey, this property is actually for me. So that'll protect you right there. So title insurance is very important. And Alek, this is also required too, right? Title insurance and um the title
Correct.
search. Yeah.
Yes, because again, from a lender perspective, like Eli mentioned earlier, we don't want to lend these hundreds of thousands of dollars and then find out that title actually might have belonged in the title chain to somebody else. Now we have a dispute. Now we have lawsuits, and somebody else comes over and takes over the house. And now what do we do with the money that we lended? So for those reasons, the lender always going to want you to have title insurance, and they're going to want you to have the home insured. Just basically like a car dealer, when you're financing a car, they want you to insure it 100%. Same thing with the house. We do require the house to be insured in case it burns down, in case of a flood. And this insurance for the mortgage purposes, we only need you to go and get a quote from an agent, and then that quote to get the mortgage now, and that quote will start kicking in on the day of closing, because you don't want to insure a house that you don't own. So on the day that you become the owner, that's when your policy kicks in. Now, lately there have been a lot of price increases on the homeowners insurance, especially in Florida, because of the natural disasters. So if you're in a market to buy a home, if you need a good quote, let me and Eli know. We work with these agents in the area, so we can help you on that front as well.
And getting homeowner insurance, that gives you a peace of mind, knowing that your property is
Yeah.
protected, right? Yeah.
Yes.
All right, let's go to the next slide. All right, so secure your finance. So after getting everything done, the appraisal, the title insurance, homeowners insurance, you secure your finance, you get the final pre-approval. Well, not pre-approval, you get the final approval from your lender.
Right. Yes, and so at that point, we are ready to finance the loan. We set up a date, when a closing date. We prorate all the taxes. We go by the contract. We make sure that all the expenses are are accounted for, and we send the wire to the title company, and you guys are ready to close on your home.
All right. The final walkthrough. So you'll have time to walk the property to make sure that the property is is in the condition that was agreed upon in the contract, right? So for example, let's say the seller said that the stove will be included and it was on the contract. But when you walk through the property, you see no stove, right? So that's why it's important. Even if you're 100% committed and you know this is this is the only property, I want this property, it's still it's a great idea to walk through the property to make sure everything is as said it would be. And if it's not, you can take necessary actions. All right. And then after the walkthrough, you prepare for closing. Um, you review all your documents, make sure everything is okay, and then now you're ready to close. All right. So closing on your new home. So at closing, you will review and sign all closing documents, which includes the deed, the mortgage documents, settlement statement, pay any closing costs required. And as your agent, I'll walk you through it all. And after doing all that, finally ownership transfers to you, and you get your new keys. You get the keys to your new home.
Congratulations.
Yeah. All right. Post closing. So after closing on your property, on your home, you start moving in, right? You bring the furniture in. And actually, if you need help with moving in, if you need help with that, I can actually find a great moving company to help you move in. Or if you're doing it yourself, I don't mind stepping in and like physically going there myself and helping you move your furniture. I'm okay with that. It's like a
Make sure
workout.
this is recorded, okay? We have a proof of it when it comes to it. But
Yeah, I got you. No, for real. Yeah.
no, I've
Oh,
seen you. You're working out at the gym. You're a strong guy, so yeah,
wow, thank
definitely
you.
can help with the moving.
I appreciate that.
Let me know as well if you guys are coming to Florida. I'll always here. I mean, to Arizona. I'm always here to help. I'll help you move as well.
Nice. Um, and post closing, stay in touch, right? So if you unless you had a terrible experience with the lender that you work with, or me as your realtor, stay in touch with us, right? Why stress yourself out trying to find a whole new person, like a whole new agent, a whole new lender, knowing that you already had a great experience with a lender like Alek and a realtor like myself. Why stress yourself out trying to find a whole different um like why stress yourself out trying to find a whole new lender and a whole new real estate agent? So stay in touch with us, and yeah, that's pretty
Right,
much it.
and on my end, let's say we get you a good rate today, which hovers around 7%, maybe 6.95. You purchase a home. What I do as a lender, I will set up a trigger, like alert trigger. So when the rates get down to, let's say, 6%, I'll immediately contact you and tell you, hey, we bought this house 6 months or a year ago. You're now paying, let's say, $2,000. But if we go ahead and refinance at this point, your monthly payment is going to drop to 1,800. Are you interested in doing that? This is one of the benefits of purchasing a home. When we're renting, you know that your rent is always going to keep going up. When you purchase, unless your taxes go up, you can only save on your monthly payment if the interest rate gets down. You refine the house, and you can get a better payment. Not to mention that if your house value went up with the refinance, now you can get a cash out refinance, get 10, 20, 30, 50 thousand dollars out of your house, and now you can invest to your next property and build a portfolio, which as it's not a secret that most wealthy people in America have done it through real estate. So that's why Elie and I are here to help you in this process.
Exactly. Just give it a second to update. All right. We made it to the end, guys. I know that was a lot, but if you guys have any questions, we're about to step into the Q&A section. All right. So if you guys have any questions, feel free to raise your hand and we will answer your questions.
I think Clarence may have a question. Go ahead and unmute yourself, or Eli, maybe you need to unmute him. I can't hear you.
Oh yeah. So I think one of the questions that I have is like, why when you about to start to purchase the home, like I noticed you guys had like a few listed documents that you guys are required, kind of like the last W-2s. I try to take a screenshot of it. I believe I do have it. So the last W-2s, which is easy. And then do you guys like remember what was those documents as well? Right.
Yes. So the last 2 years of W-2s, if you're an employee, last 2 months of bank statements. We're going to need ID. We're going to need last 2 years of tax returns and the last 2 pay stubs. Those are the documents that we will need.
Yeah, these are easy.
Yeah. And then we will run credit report. So you do a mortgage application. You authorize us to run your credit, and we run your credit. Once we collect all of it, it takes about 24 hours to let you know whether you're a good candidate for a mortgage loan and what is the amount that you can go out and shop for.
All right. That's basically the questions that I have, and you made it very easy. And I have all those documents.
Clarence, if please write down my number and my email if you think of any other question as far as mortgage. I'm always available to help. My cell phone is 480-382-2870. You want to text me, call me anytime. I'll be happy to guide you through the process.
Yep. Can you repeat it one more time? It says 480.
Sure. 480.
Drop it in the chat. What's the number?
480-382-2870.
All right, I got it.
Okay.
Oh, sorry. All right.
You have any other questions, Clarence?
Oh, no, that would be it.
Okay. Thank you for that question. That was good.
Thank you, Clarence.
Hey, you got.
Oh.
But the whole presentation went good, and then whatever you guys are doing again, I'm down. Basically, like the more you guys do it, the more I like start to see. It's like I felt like I was experiencing like a home buying process. The way you guys broke it down with every details, with every explanations, like all the questions that I have is basically answered to that whole presentation. It's like very short. And if you guys want to do it right now, again, I will still stay in the video and then just like do it. And that's great work. And you guys should be proud of it. It's like that's really great work.
Thank you, Clarence. I appreciate it. And what I want to mention here again is a lot of times people think that they may not be able to qualify based on what they see in the presentation. Now, there's right now, for example, there is a program with one of the lenders that we're working with that is giving 3.5% towards down payment on your FHA loans. And if you remember in the presentation, the FHA requires 3.5%, which means the lender will give you grant for the whole down payment. Right now, you have zero to come up for down payment. Now, you work with Eli, right? Eli finds your property. The property has been sitting on the market, let's say, for 2 months. So what Eli can do is go to that seller and tell them, hey, I have a buyer. He's qualified. He can get a mortgage. Can you help with the closing costs, right? And if that seller has been sitting for 2 months on the market, he wants to sell, right? So he's going to calculate and say, well, yeah, out of the proceedings of the house, I can send a few $1,000s towards closing costs. Yes, let's do it. Give me an offer. So now your closing cost is zero, right? So if you have good credit, if you if you've been on the same job, if you're ready to qualify, but you haven't saved enough, which we all know these days it's so hard, right? With inflation, with all these prices, with rents being so high, it's so hard for the first time home buyer to come up with 20, 30, $40,000 to get into a house, right? But with these tactics, we can virtually get you into a house for less than what you would pay to get into a rental. That is why it's so important to keep pay your bills on time, keep your job steady, keep your finances on track.
And mentioning good credit.
Yes.
Yes. Yeah, you guys are awesome at what you do. Like that.
All right.
This this is being recorded, so it'll be posted on YouTube. So you can always go back and rewatch it.
Yeah.
Awesome.
Any more questions, guys?
I have two myself. Well, my first question is, say if you're pretty much co-signing with somebody for a house, would there be, would there be more steps, or was everything just the same?
Okay, so when it comes to co-signers, we will also need to see what is the status of the co-signer as far as mortgage. Is that co-signer going to live with you? Are you related with the co-signer? And the co-signer is going to have to get approved as well for that mortgage. So that means the debt to income, everything is going to have to be on track. It's always easier if that co-signer is going to live with you. It's part of the family. However, it's also possible to get it done with somebody that's not going to live in the property. But they need to understand that it is going to be their responsibility in case you make a late payment, or you stop making payments. It's going to affect their credit, and it's going to so there's got to be this trust between the co-signer and the purchaser. But yes, it is absolutely possible to get it done with a co-signer. Yes.
Okay, sounds good. And then for my second question, I do know that earlier in the presentation, one of you guys did mention about house hacking as a way to make passive income, but would you guys be able to like further explain that?
Yeah, so there's different ways you can house hack. So you can house hack with a multifamily. So that's like a type of property where you have multiple units, right? So for instance, like a duplex, right? There's like two sides, two units. If you are able to purchase a duplex, you simply live in one side, one unit, and then you rent the other unit out. But you can also do rent by the room method, where you buy a single family, which is like one unit, it's one door, and you have multiple rooms, right? It could be a 3-2, right? So about rent by the room method, you purchase that single family and you simply just house hack the rooms. You're renting the rooms out to subsidize your mortgage payment.
Yeah, no, on the from a lender point of view, if the house can have up to 4 units, meaning you can buy a fourplex, and as long as you live in one of the units, it's considered your primary residence. So you're getting the mortgages that are meant for a primary residence, which are always have better terms, lower down payment, lower interest rate. And the beautiful part is if the rest of the house is rented, and even if it's not rented, when we do the appraisal, we run an appraisal for a rental appraisal. So we're going to evaluate how much the other 3 units are going to be making, and we add that towards your income. So when Eli was mentioning earlier, if your income is not all the way up there, now you have 3 more units that you don't even own yet, but they calculate towards your income so that you can actually, it's going to help you purchase that house. So this is a really, really good way to get into a house, and not to mention that they can be paying off your mortgage, right? The other 3 units can be paying off your mortgage if you find that good deal. And again, this comes back to working with a good agent in your area that's going to help you locate these properties.
Okay,
Yeah.
okay. But that's all for me. Thank
Okay,
you.
Mark. Yes,
Right.
thank you for the question. That was a great question. I think, Eli, if you want to do this again with our next session, we can actually talk about more of this home hacking, because I believe there's a tremendous interest for this. So we can break it down and show all the possible ways and how we can go about it.
Yeah, definitely. I agree. Like the investing side of real estate, I think
Yeah.
a lot of people would benefit from that. Yeah, for sure.
All right. Any other questions?
I think that's all the questions.
All right, guys. Well, thank you so much. It was a real pleasure. We'll see you next time.
All right, thank you so much, guys. Thank you for taking the time to attend this presentation. I appreciate everyone here.